get more on Citigroup. For that, we're joined by Anton Schutz. He is on the phone. Anton, by the way, is president and founder of Mendon Capital Advisors, which owns about 1 million shares of Citigroup. Anton, good morning. A lot of numbers from Citigroup this morning. Quality of earnings. If they didn't release that $3.3 billion from reserves, they would have had a loss. Do you think these are healthy earnings, bottom line, for Citigroup?
Well, yes and no, because you punish them when they put those reserves aside for bad loans, over the last few years of trouble, and now you can't punish them on the other side for releasing them. I mean, the good news is credit performance is much better. They still have 5.79% reserves to loans. I mean, it's a colossal number compared to the rest of the industry. So, you want to focus on some of the things that are important, like book value being $4.69. Earnings from international was 72% of income, 62% of revenue. There's a growth story here at Citi. You're not getting that kind of growth that's going on at a lot of the other domestic banks. And, what's going on is they're reinvesting a lot of the revenue they earn into building out being where that growth is.
Anton, your firm owns about 1 million shares at this point. Anything in this report that makes you want to either add to that position or potentially maybe sell some shares here, depending on how the stock plays out today?
Well, I'm definitely not a seller, and I think that we're going to have book value close to $5 by year end. The balance sheet continues to get healthier. Credit costs were down 61% over a similar period last year. So, it's really hard to reward or punish these companies based upon trading results every quarter. I mean, the one thing that's clear is loan growth is still sluggish. Mm-hmm. There's absolutely no doubt about it. The U.S. isn't growing very rapidly, and I think you can see that from everybody. But the other thing that is clear across all the rest of the banks is, particularly in the credit card side, credit costs are down dramatically, and those reserve releases, like I said, the stock and the company got punished for building those reserves and having those losses in prior years. You can't punish it again for releasing the reserves.
What about some of the long-term concerns that are still at the company? I think there's a government watchdog report that basically said during the quarter that the bank was still too big to fail. I mean, is this still, in your view, I mean, you own the stock, so I'm thinking maybe not, but is this still to some extent a troubled institution to kind of keep your eye on?
Well, I think the word troubled is I think overstating it. I think clearly troubled 2 years ago was an accurate word. There's no doubt its non-performing loans are dropping dramatically. Mm-hmm. Its equity capital is dramatically higher. It's paid off TARP. The government actually has allowed it to pay a meager dividend, but nevertheless it's allowed it to pay a dividend, which again, the regulators clearly do not want to come in and rescue any of these companies again anytime soon, if not ever. And there's no way they're going to let them return any capital unless they're very comfortable. So, like I said, the dividend is meager, but it's an important vote of confidence. And
they're at least reporting a dividend. Anton, what does also the results say about Vikram Pandit and the job he's doing at Citi?
Well, I think the job he's done has been to, slash costs and slash the side of the balance sheet and reduce risk and build capital. So those are all very, very important things. And, Citi's definitely not on the brink of collapse by any means. I think, the Vikram Pandit story will be, yes, he saved it. But the next story will be yet to come, which is, what kind of growth can he achieve here? And there's clearly been a lot of building going on, which, again, that's good news. You don't have a company taking in its horns. It's actually out there expanding in Latin America and expanding in Asia, and those markets are growing.
So you like that the company's adding branches? I mean, they're expected to add a few hundred branches?
Yeah, and they're adding them really, for the most part, in very high growth parts of the world, and I think that's important. I think that's the way you've got to look at this company as a potential growth company. It's coming out of the ashes. We got a reverse stock split coming here, so it'll actually have a respectable-looking stock price. But it's not a company in decline. It's a company that's been gradually improving.
Anton, one last question. I want to go back to the stock. You said you're definitely not a seller. We know you guys own about 1 million shares. Stock's up a little bit here in the pre-market. Any reason to maybe add to that position, or if not, what would make you add to the position?
Well, I think given what I said about book value, about $4.69, and it'll be about $5 by year end. I think in 2012, this company will return a lot of capital to shareholders, a lot of buybacks, a lot of dividends. I think a normal earnings run rate is going to be somewhere between 60 and 80 cents a share. So, yeah, I think the stock is very cheap, and I think this is a pretty good level. If you want to take any sort of intermediate to longer term look at this stock and put it away and own it.
Got it. Anton, we're going to leave it on that note. Thank you so much.